All right, we will be covering our credit basics lesson for today. So the whole idea of credit is just that we are receiving goods or services today that we cannot pay for until later on. And so the idea is that we are promising to help pay back this determined set amount of money, and this number is determined because we are going to be paying back our principal or that original amount that we purchased, in addition to interest that we will pay back to this credit company or the organization who offered us the loan, and we are paying that back in the future. And the available credit that we have is different for every single person, and that is because it is dependent on how trustworthy you are to pay back this amount of money. And this is going to factor in a lot of different things like your age, your credit history, so how have you paid back things in the past, as well as just the organization and possibly the economic climate as well. We have 5 to 6 main sources of credit that we can go through. People usually immediately jump to the idea of credit cards, being this bubble up here, but anytime we get a loan or are given something today that we're paying off long term, that is a form of credit. So paying for getting an auto loan and paying for your car over time, that is a form of credit. The same as paying for a mortgage company or paying for your mortgage on your home, getting federal student aid, so getting a loan from the government to pay for your education, as well as just getting a personal loan through a depository institution. We know that those depository institutions are just banks or credit unions. And then lastly, we have pawn shops, which we will talk about a little bit. When we are borrowing, we really are truly spending our future money. I am deciding to borrow because I don't have the money to pay for it today. So I am going to make that decision to dedicate my future money in order to paying off this loan or paying back this amount of money that I borrowed. And usually that means paying back more than the original amount. Interest, we've talked about interest being the money that we could earn or a form of income for us through savings and investing tools. But now that we are into credit, we will talk about the interest that we actually have to pay out. So if I were to get a $10,000 auto loan that charges an 8% interest rate, typically those are going to go on for a couple years. So maybe I'm making monthly payments for 3 years. I'm going to end up paying off that $10,000 and I'll be paying an extra $1,280.96 to this auto loan as a form of interest. So had I been able to save up that $10,000 myself, I would be saving almost $1,300. With this being said, that does not mean that credit is always bad. Credit can be a really, really positive thing as long as you're managing it appropriately and responsibly. Or if you are not managing it responsibly, you can have severe financial impact, negative financial impact. So it can change the way that you are able to function and your quality of life just based on the amount of debt that you owe. 3 ways that we could manage debt in a positive way, or 3 types of credit that are seen in a positive light, are going to be investing in your human capital. So getting an educational loan, we know that getting this loan does mean that we will be in a little bit of debt, but we know that anytime we invest in our human capital, we increase our potential earnings. So by going to school, I'm going to have a higher lifetime earning potential, meaning that that debt was worth it. The same goes for buying a vehicle. It's a lot easier to get to and from work if I have reliable transportation. So that's a kind of positive debt. And even having credit cards can be seen as a positive as long as you are making purchases, maybe for emergencies, or consistent purchases that you know you can pay off in a timely manner. A couple things that we do need to ask ourselves before we even decide to open up a line of credit is, do I already have money saved up that I could spend instead of putting this on credit? Or is this something that I need to buy right now? Or maybe could I wait until I actually have the money saved up? If I'm able to save up the money, I do have some benefits because then I'm not in a contract to pay this back. I'm not being charged any interest or any fees, and I'm not spending any of my future income. The main downfall is that also means that I'm not building any of my credit. When we do decide to open up a line of credit, we are going to be given a contract. Every type of credit comes with a contract. And this contract is going to outline how I need to pay back this money and when I will pay back this money. In addition to those two really important details, it's also going to identify the terms of the contract. So what is the interest rate that I will be charged for my purchases? Thinking about both right now and in the future, is this a contract that I'm going to be happy with in 2, 3, 5, 10 years? And then are these contract terms consistent? Sometimes they will make a contract where my interest rate is really reasonable for maybe the first year or 2 years, and then after that it increases. So is my interest rate going to jump after a short amount of time, or is it going to be consistent for the entire time that I have this credit or this loan? And we also need to consider the amount of money that we're borrowing. I can do this in two different ways. So I can look at the total amount of the loan. And when we look at the total amount, we want to make sure that my loan or this credit or debt is not more than 20% of my annual income. Or we can think about our monthly budget and looking at how much these payments would be each month. Is that something I can afford? This number should be less than 10% of your monthly income. And then we have two main categories that all of these types of debt will fall under. And so we first have installment credit. This is also called closed-end credit, so we'll probably use those interchangeably throughout the unit. And this is going to be a loan where I pay the same amount of money every month for a set time frame. So things like an auto loan, a personal loan, student loan, or a home loan, I know what my total amount of the loan is. And then by calculating the interest, I can determine how much I need to pay every single month. So if I know that I'm going to be paying $300 a month, it's a lot easier to budget. Alternatively, we could have revolving credit or open-end credit. And this is going to be something more similar to a credit card where I am initially given a credit line. If I open a credit card, they may give me a credit limit of $1,000. I am able to use that $1,000 as I see fit until I've used all of it. Depending on how much I charge to that card is going to change how much I pay each month for this credit card bill. So if I charge a lot one month, I'm going to be paying more, or if I don't charge very month, my payment may go down. And then lastly, we have alternative credit. And this doesn't really fit into either of these categories, mainly because it pulls elements of both of them. They usually are very risky because they have higher interest rates and they usually have quite considerably higher fees. The first type is going to be a payday loan. This is a really risky way to get a short-term loan that's usually going to be for a smaller amount of money. So I'm going to go through a scenario of what a payday loan might look like. I might go in, try to get a payday loan for $350. Not a ton of money, but I just need that cash today. There's going to be a fee that is associated with it. I may pay a $60 fee in order to get this $350. So in reality, I'm only leaving with $290. This lender is going to set a specific time frame that this loan is for. I'm going to repay this in 1 week or 1 month. If that month rolls around and I do not have that money, then there are two options that the lender can go about. They can charge me some fees, and they could even take me to court for not paying back this loan, or I could pay them another $60 and extend that loan out for another month or another week or whatever the time frame was. This essentially means that I'm taking out a new loan. We're going to skip through this activity. The third type is going to be a rent-to-own scenario. So maybe I moved out into my own apartment, but I'm not able to afford my own furniture. So I could go through a rent-to-own company, and I could rent a couch, a fridge, a television, whatever I need for my home, with the intention that I'm going to eventually pay this off and it will be my item. So in this scenario, I may be renting a 50-inch TV. It's valued at $2,000. I've agreed to a contract where I'm going to pay $40 a week. I'm going to pay for 2 years. 104 weeks is 2 years. And in the end, this TV is now mine. I've paid for it for 2 years. It's my TV. I can do whatever I want with it. But overall, I've paid for over $4,000, meaning that they earned about a 92% interest rate. I could have purchased 2 brand new TVs for the amount that I paid for this one television. The fourth and fifth type, we're actually going to combine into one slide. So a title or a pawn loan is going to be where I go into a title or a pawn shop and I either give them my car title or some other personal property that has value, like electronics, jewelry, a watch, maybe a TV, something like that, a stereo, and they're going to give me cash for it based on how much that item is valued at. They're going to, just like the payday loan, they're going to give me a certain time frame that I need to come back within, and I need to pay back the cash that they gave me. If I can't pay that cash back, or I don't come back within that same timeline, that item is now theirs. So if I gave them my auto title and I didn't come back to repay that loan, they now legally own my car. Or if I gave them some jewelry and I didn't come back or I didn't have the cash, they now legally own that piece of jewelry. So there are really high stakes whenever you are using a pawn or a title loan. And then lastly, we have what we call a refund anticipation loan. We talked about taxes and about how we are going to get a refund at the end of the year for our tax return. If I've been keeping up with my tax deductions every month, I may be assuming that I get a $500 tax refund at the end of this year. So at the end of 2020, I'm going to get $500 back from the government as a way, because I deducted too much from my taxes every month. Knowing this, I could go to a refund anticipation loan office and I could decide that I want to get a refund anticipation loan. I can tell them that I am assuming that I will get $500 back at the end of the year. So they're going to charge me a fee and they're going to give me that $500 in cash. By signing this type of contract, they're going to go to the IRS. They'll go through the IRS and they will immediately take that money. So whenever that refund from the government is pushed through, it's going to go straight to the lender. It's not going to go to my account. If for some reason I was refunded less than what I thought I would, I still owe that money. So if I thought that I was going to get $500 back from the government, but I really only got $300, I am still responsible for paying back that $200 difference. We also have a process that we're going to go through whenever we want to obtain credit or open a new credit line. It's not going to be the exact same based on the type of credit, but they're all going to be pretty similar and go through a similar process. So we start out with a credit application where I give them some of my personal information, and basically I'm just letting them know that I would like to open a line of credit or get a loan from this institution. They're going to ask me some questions about my personal information, maybe my ability to repay. So how much do I owe every month? What are my current bills every month? That tells them how much extra money I have to pay off the loan that they're going to give me. And then they're going to look at my credit history. So they're going to evaluate my credit score and my credit report based on other types of credit that I have. If I have never opened a credit card before or have never had a loan, then that means that I don't have any credit history. The trade-off of not having any credit history is that they're going to charge me a higher interest rate. They charge me this higher interest rate because it is a little bit more risky to give me a loan just because they have no knowledge on how trustworthy I am. So they're going to ensure that they'll get some of their money back by charging that higher interest rate. We are going to want to look around whenever we shop for credit. So we're not going to want to just go to one auto dealership or look at one credit card company. We're going to want to shop around. So we want to look at different types of credit terms that are outlined in the contracts. So what are the average interest rates charged? What is the average time frame for this type of loan? Are there any fees associated with this credit card? Those are all really important information. You also want to read the contract carefully before you sign anything. And then lastly, ask questions. Most places where you could go to get a loan or credit institutions are going to have a 24-hour hotline. They're going to have some customer service representatives that you can ask any type of question that you would like to. And that's going to help you get a better idea of what type of credit is best for you, what company is best for you, and if this is a good financial decision. So again, whenever we're looking at this contract and we're evaluating, we want to look at the interest rate. How much are they charging me every single year? Look at any fees that they may charge. Is there a maintenance fee? Is there an inactivity fee? What does that look like? What happens if I miss a payment? What are the consequences? Do they close out my loan? Do they repossess my car? Do they just charge me a fee? What does that look like? What happens if I get to the end of my loan and I haven't paid it all the way back? What if I have defaulted a couple months? And then, does this lender feel trustworthy to me? If it's a large company like Discover Card, MasterCard, most places that you would get an auto loan through, they're going to be pretty trustworthy. You should feel pretty comfortable working with them. But especially if we are looking at those alternative credit methods, a lot of times they are a little bit fishy, and we want to know if they are a trustworthy organization. And while we will not practice looking over a contract right now, it is just important that these are some ways that you can better evaluate a contract. Making some notes, so circling items, maybe starring them or leaving a little dot next to something that you want to come back and look at. Underlining some of the important information like interest rate, fees, consequences. And then just once you have gone through and you have annotated it and marked it all up, thinking, are there more positives than negatives? This is a contract that I would sign today and be 100% happy with. And then just ending with these last three considerations. You do have responsibilities as a borrower to pay back this money, to pay back the interest, and to do it in a timely manner. You are responsible for considering what are those future implications. Am I going to be happy in 10 years that I took out this loan knowing that my future income would have to go to pay it? And then have I spent enough time shopping around? Have I looked at enough companies or organizations to know if this is the best option for me?